Hello and welcome to Livewire's reporting season coverage. My name is Chris Conway. With the dust literally still settling on an incredible reporting season, I'm joined by Ben Clark, portfolio manager and partner at TMS Private Wealth. He's going to take us through the week that was of reporting season, as well as some thoughts as we head into the second half of the year. Ben, great to see you. Thanks for agreeing to have a chat.
Yeah, I was just saying before offline, I'm looking forward to a good lunch. It's Friday. We've made it through. We've got Live 360 on Monday, but everyone's pretty much done and dusted now. So wild reporting season. But I did see a fundy say volatility is the new normal. And I think we've got to put aside what we were used to seeing in terms of share price reactions.
Absolutely. You'll have earned that lunch by the time you get to sit down, Ben. Just to provide some context for the audience, another massive week, more than 70 companies reporting. Some of the really big names, Fortescue, Coles and Woolworths, which we'll talk about in just a moment, a whole bunch of mid-caps. All the while, the ASX 200 is hitting fresh all-time highs. That belies the story that's going on underneath. And of the 3 weeks, the story arc has sort of been, the first big week was pretty tough. There was a lot of volatility, some bad results, followed by a strong week last week, and then we're about to unpack this week. So, I guess Ben, what did you make of this last week at a headline or highlight level?
Yeah, look, I felt it was pretty good, Chris. I mean, there's been a few mid-cap sort of disasters out there that have been hit hard, but if you're looking at, let's say, ASX 100, ASX 200 even, I think that second week, which is when most of the results drop and was good, has flowed into this week as well. And I think generally you'd have to say that results at a broad sense across the market level, I would say this has been one of the best reporting seasons I can remember in a long time.
Funny that one of the best, but probably also one of the most volatile that we've seen in recent memory as well. So let's unpack it a little bit further, Ben. We'll start with a couple of pairs of similar companies. So first of all, Light and Wonder and Aristocrat. Now I know Aristocrat wasn't a result; it was more an AGM. Just on Light and Wonder, the results to me they look pretty solid, beat consensus, and of course competitor Aristocrat. Like I said, they had that AGM. What did you make of that pair of companies?
Yeah, and we own both these companies, so follow them pretty closely. And this is the first time Light and Wonder's reported as a sole ASX member, having moved off the US markets late last year. So look, I thought the Light and Wonder was a really solid update, particularly on the margin guidance. So good sales, better than expected margins equaled a better half yearly profit. Not a lot better than the market was expecting, or sort of low single digits. But that's a win in our book. And the reason we did see actually an initial pop on the news and then a slide off. And I think that was because the lack of guidance. Light and Wonder, for as long as we've been following it, has given medium-term guidance, which a lot of companies don't do. There was no guidance with this other than we expect to continue to see growth. And maybe that's a change in direction now that they are a sole listed ASX company. But there might have been a bit of disappointment around that, but I think it was a good result.
Let's pivot now to another pair, Woolworths and Coles. This is a tale of two cities, isn't it? So Woolworths was the bolter, up 13% on the day results earlier in the week. You just don't see that sort of excitement from the supermarkets generally. And then Coles this morning, I'll let you tell the story, but how did you place those two?
As you know, Chris, a lot of share price reactions you see to results is not actually to do with how good or bad the result was. It was what the market was expecting it to be versus where it came in. Expectations for Woolworths were low, and the result was better than consensus estimates across the market. Not a whole lot better, but there were some really encouraging signs there. And we have seen a period where Woolworths has underperformed against Coles. So what I call out with Woolies is three of the sort of the problem childs in recent years have been Big W, the New Zealand business, and Petstock. Both of those showed much better results. And then the core Australian food and bev business was good and good cost management. It feels like it's returning to market leadership. So that was a big tick. And then Coles, which got hit hard, came bang in line. And pretty much every single number was in line with analysts' expectations. And I just think that company has had a track record of beating expectations for some time now. And an inline wasn't good enough for the share price to keep going again. And maybe we're just seeing, these two over the years have had the market swing back and forth. And I think we're starting to see Woolworths come back at Coles.
Yeah, you make a really good point, Ben. It always is about the expectations going in. Let's talk about another company now that maybe had some lower expectations going in, given the recent history, shall we say. Of course, I'm talking about WiseTech, a positive share price move. I think what stole the headlines, though, is the job cuts. But what did you see there?
Yeah, so I went to this briefing. I would give a shout out to WiseTech in that these briefings are almost perfectly 30 minutes of management commentary and 30 minutes of Q&A, like every single company for as long as I can remember. WiseTech went for nearly 2 hours. They took every single question that analysts had, and they spent a lot more time than the 30 minutes going through. And really, we all know the market at the moment is freaked about what AI could do to software businesses. And the only way that you're going to try and get some more rationality in the pricing of the shares of these companies is to educate everyone, analysts, myself, whoever's listening, on what the company is seeing and why they think that won't happen. And I think WiseTech, most importantly, did an incredibly good job at explaining why they will not be disrupted by AI. So that, for me, was the biggest tick. The job layoffs were pretty interesting. Like, to me, it's a little bit scary. Like, I've listened to every earnings call that WiseTech has done since it's been listed on the Australian share market. They've been talking about AI throughout that journey, and suddenly, no one really wanted to know about it. Now everyone wants to know about it. I think they were probably one of the first Australian companies to truly embed AI in their business. And they're also one of the first companies that has announced a 35% reduction in headcount. We've had Block this morning announce a halving of headcount. So, like, this could be the canary in the coal mine. It's of what's to come, because the fear is, when does this move to Main Street? And that's a big question mark. But look, I thought it was a great first half for WiseTech. I think the second half guidance is conservative, and in FY27 they are going to be coming onto a radically lower cost base. So I think the stock's a buy.
Let's pivot to, pardon me, Fisher and Paykel Healthcare. So again, it wasn't results as such, but they did provide an update. I think, Ben, if I'm not mistaken, the third upgrade in a row. So they seem to be going pretty well.
Yeah, so another one we own, and I wanted to give a shout out to, because this was a really strong update. Felt like it got a bit missed in all of the news that was coming out. And as you said, this company's been in an upgrade cycle for some time now, but the market really hasn't given them the reward for it. Trades on a higher earnings multiple. That earnings multiple's compressed quite significantly. But look, it was a strong beat versus their initial guidance, or a strong update. And I guess an outlier there is that this company produces a lot of its hardware in Mexico, very close to the border with Texas, and they will potentially be a beneficiary of the reduction in tariff rates that Trump's now going to have to employ. And they're even talking about, a big question mark is, are you going to be able to get any of this money back that we've effectively mispaid? I mean, I think good luck with that, but worth a try.
Yeah, I don't like the chances of anyone getting dime one back, mate. But anyway, we shall watch that space. Let's pivot again. Let's talk about Monadelphous Group. So the share price reaction seemed pretty wild. It absolutely surged, and then it came back to earth a little bit. Record revenue, lots of new contracts. What did you make of it, and their guidance as well?
Yeah, so one we don't own, unfortunately. I wish we did, because this was a cracker, probably one of the best results when I had a look at it that I saw. It was a strong beat versus expectations, a strong guidance upgrade versus expectations. And we did used to own Monadelphous many years ago, and I know that these guys are two things. They're very conservative. So if they're delivering that strong guidance upgrade, I reckon they're pretty certain that they're coming in there or even above it. And very good cost management, because we know at the moment these mining services business are an absolute beautiful point of the cycle. The question for the shareholders of these companies who have done well to be there is, when do you sell out? Because they are cyclical, and maybe that volatility we saw around the results, just a bit of a sign. Is this, the conditions as good as we're going to see? But Monadelphous is very good on its cost base. It's been through cycles before. It's not going to be a business that's guilty of thinking this party is going to continue forever.
Let's talk about Ramsay Healthcare. This was another one that enjoyed a really nice pop in the share price, 10%, beat on revenue and NPAT. What's more to the story there?
Well, Chris, again, I think expectations is a big part of this one. This company's been in a downgrade cycle since I can remember. And there's two things going on under the hood. The first is a roadmap to a simplification of the Ramsay business. Ironically, getting probably back to what Ramsay was 10 to 15 years ago. How many times do we see this in markets? So they've got a definitive plan of how they're going to demerge the French assets. It looks like they're making some progress on turning around the UK assets. And the big pleasing point was some signs of growth in the core Australian business, which they're going back to investing back into, and they're starting, their commentary was more optimistic than the market expected. The issue still with Ramsay, I would call out, is the balance sheet. They've got a lot of debt on the balance sheet. I guess there's a lot of operating leverage on the balance sheet as well, but I think that's going to need to be dealt with at some point.
It's an interesting point, Ben. I immediately think of misadventures of the likes of QBE in international markets and ANZ. They always try and expand offshore, realize that they're better off pouring the money into developing their opportunity back home, and then the share price responds accordingly, doesn't it?
Woolworths.
So, yeah, the same old playbook. Let's round out at the stock level by talking about another one that had blistering performance, nice share price pop, and that was Reece. Again, maybe coming out of a more troubling period. What drove that, and I guess, is it sustainable?
Yeah, this is an interesting one. So this is also a company that we used to own more recently. And the thing I'd say, Peter Wilson's earnings call 6 months ago was one for the ages. I've never heard a CEO be so brutal in his assessment of what was going on for the company and some mistakes potentially that they've made. Again, I think that lowered expectations. The company came out with a beat versus where the market was at. The time to buy this stock, Chris, was when they announced, and I'm kicking myself that we didn't buy it back in, when they announced a off-market buyback to take out at the low, take out a bunch of shareholders. It tightened the family's control over the business and reduced shares on issue at a great time. So, look, I think Peter Wilson was still fairly downbeat on the near-term outlook and certainly wasn't getting carried away, but the numbers suggest that the worst is behind this company.
Ben, I've done some research on insider buying and buybacks and things like that, and yeah, it is a telltale sign that when the key holders are buying more stock back, it's a time to take another look at the stock. So hey, we both missed that one.
I'll just call out, the software part of the market, the technology part of the market has been the big talking point. We've seen this incredible market strength broadly, but there's parts of the market that are really out of favor, effectively in a bear market. What we have seen is some pretty aggressive directed buying in some of these stocks. So Pro Medicus is probably, we've seen the most aggression. Cameron McIntyre at REA bought a big whack. The CEO of WiseTech, it was announced this morning, has bought $1 million of shares PA. So, and we're seeing similar patterns in the United States. Companies like ServiceNow, which would typically have management sell downs post results, cancelled them, and we actually saw management buying. So hopefully that's another sign from the insiders that they see this as an overblown reaction.
Yeah, that's incredibly important insight, and I've had the great opportunity to speak to Sam Huppert over at Pro Medicus a couple of times, and he's bought stock a couple of times. So that is, indeed very, very interesting. Ben, the dust, it's literally it's still settling on the season, but just taking it up again to a broad level, what were some of the key takeouts for you and things that you think investors should be mindful of over the next 6 to 12 months?
Yeah, so I started off by saying this has been the best reporting season I can remember. And the reason for that is it's been broad-based. The banks have beaten expectations. The big miners have beaten expectations. Companies like Woolworths, Ramsay Healthcare, in the big end of town, CSL was the only stock I can think of that disappointed. So the pleasing thing is we are seeing top line revenue growth alongside disciplined cost management. A lot of companies have really struggled to grow their top lines for some time now. So it's all been on the cost level that they've had to eke out some earnings growth. So strong cost management. Balance sheets are great. So there's still conservatism amongst CFOs out there. So that's why I think this has been a tick, and I think there's some momentum in this market. I think this can continue on into next year, into the second half of the year. But you can't go past it. I'm sort of sick of talking about it. But if you listen to these analyst calls, that there's the result, the presentation, the result, the outlook, and then there is 30 minutes of questions on AI from analysts. Every single question is on AI. No one's even talking about the result. And it has been the theme that has completely overtaken what's going on. Like everyone's got the reality is none of us know exactly in many different industries where this is headed, and we're all trying to get a sense of it. And I think even the CEOs, if they're honest, are saying, we're not too sure ourselves, but this is what we think we can do, and we don't think this is right. But that has been the dominant narrative of the Australian earnings season.
Ben, thank you so much for sharing your time on what has no doubt been a busy day and after an incredibly busy period. Mate, as I said at the top, I think you've earned that lunch, so go and enjoy it.
Thanks, Chris. Thanks for having me.
If you enjoyed that conversation, make sure to give it a like, and don't forget to follow our YouTube channel where we're always adding lots of great content every single week.